What's going on, investors? So today on Investing 101, we are going to talk about lending options. If this is your first time watching this series, it's more geared toward people that are maybe just getting started off, or maybe they just want to learn the basics. Maybe you got started in a different field, maybe it was commercial, and now you're trying to switch over to residential, whatever that is. Today, we're just going to keep it short and sweet into the basics. We're going to talk about lending options again. Um, let's just jump right into it. So for starters, FHA. So there's a big misconception that the FHA loan is a first-time home buyer's loan. That is not true. You don't have to be a first-time home buyer to use an FHA loan. It's a government-backed loan. It's a great low down payment loan. You can buy up to 4 units with it. You just can't have more than one FHA loan at one time. Now, there are some exceptions and exemptions to that, but typically speaking, you only can have one of these out at a time. So say you buy a house, a primary residence, and over some time it has some equity into it, you could refinance this loan to a conventional loan and then go buy another loan using another FHA loan. So again, big misconception with this loan is that it's for first-time home buyers. It's not true. Next one's going to be conventional. Again, this is another government-backed loan. It's called a conforming loan. So when you hear that term, that is because this loan product is going to get sold on the secondary market to other investors. So it has to meet a certain criteria of credit score, DTI, which is debt to income ratio, stuff like that. So they're going to be very strict on what you can do and what is not going to qualify for a conventional loan. You can't buy a house that's not livable and stuff like that. Typically, conventional funding will not fund that loan, especially with FHA. That was one thing I didn't talk about is that when they go to send an appraiser out to appraise the property, they are going to be very scrutinizing to the condition of the property, and they will require you to do repairs because the FHA loan is a primary residence loan. So obviously, you have the intention of living there, and if the property is not livable, obviously they're not going to fund it. So conventional, they're not as bad. They will still fund some properties, but it just depends on the condition of the property. Another one, hard money lenders. This is talked about a lot in the investing world. All hard money lenders are is basically it's either a fund or private investors that pool their money together, and these typically are more expensive. They're going to be your 10 to 14% loans, but these are going to be like your fix and flip loans or a BRRRR loan. They typically require like 10 or 15% down, and they're usually short-term loans. And they also have loan products that will fund renovations, can be used as a bridge loan. But again, this is not going to be something you're going to go buy like your primary residence lift with is hard money, because it's typically going to be more expensive because there is usually more risk. These are properties like that won't qualify for FHA or conventional. Usually you could buy with hard money if you need to. I started out using hard money until I was able to start paying cash for like the first part of my process of buying BRRRRs. I would buy them using hard money, and then after I do the refinance or after I did the rehab, I would go refinance out of the hard money loan into a long-term debt loan, because they are typically 12, 24 months is all you're really going to get for a hard money loan. And again, this is not like a bank. They're usually other investors or funds that do this because they do pay a pretty good return. A HELOC, again, we're just going over terms really. A HELOC is a home equity line of credit. You're basically using the equity in your home as collateral, and your bank will give you a second mortgage on that house. That's how they secure themselves, by putting a second lien on your property. So typically these can be 80, 90% of the LTV. But you got to remember, if you have a first position lien, say you have a $100,000 house and you only have a loan for 50,000, that means, oh, I have $50,000 in equity, I can just access that. It's kind of a little bit of a misunderstanding. You can't get $50,000 from that house. If a bank's going to give you 80% of the loan to value, that means if you have a $100,000 house, they'll give you up to 80 grand. Well, if you already have a primary loan at the first position of 50,000, there's only that $30,000 spread that you're actually going to be able to access as far as a home equity line of credit. Again, these are typically short term. Don't go out and take a HELOC out and then go buy another investment property using 20% down or something like that. It's good to go buy a flip or a BRRRR and then you pay yourself back. But people don't understand these are not long-term loans, and they do adjust typically. So don't go use a HELOC in your primary to go put 20% down on an investment property. And I think a lot of people are getting caught up because they saw how COVID, all prices were going up 10, 15% a year. You can't bank on that. Like you can't bank on, oh, I'm going to buy it 20% down right now, and then in 4 years from now, that fourplex is going to be worth so much more money now that I can refinance, get my money from my HELOC back out, and then pay off my HELOC. That's not going to happen, guys. We're not seeing that kind of appreciation. So unless you're forcing the value up like a BRRRR or a flip, do not use a home equity line of credit to go buy another investment property. It's a horrible idea. And now your primary residence is at risk if you default on that one as well. So just a little 2 cents there from me. DSCR, this is a loan I use pretty much on all my properties for my long-term debt. DSCR, I could spend a whole episode just breaking down a DSCR loan. It stands for debt service coverage ratio. So in a nutshell, they're lending off of the property, not off me personally. And there's no limit to how many loans that you can have of this. Like for example, I wouldn't be able to apply for conventional loans because you can only have 10 conventional loans at one time, unless you go jumbo or something like that. Again, getting into the weeds, we're not going to do that. But DSCR, it lends off the property. Basically, there's a formula, takes your income and expenses, and it spits out a number. And basically, they're saying, okay, this is a rental property. Is it going to be able to, basically pay for itself? Is it going to be able to pay with the mortgage with what the rent is? So they're lending off of the property, not off of me. Now, your credit score still has a big impact on this, but these are also called like no doc loans. If you hear somebody say that, that means they're not asking for your W-2s. They're not asking for your bank statements. They're not asking for your tax returns because they don't care. They're lending off of the property. Now, some banks are kind of like in the middle. They still might ask for your tax returns. You still might ask for your bank statements, but it's more so just like an initial underwriting thing. Like my bank did that at first. Like, hey, can you give us a PFS, which is a personal financial statement, just kind of showing like, okay, show me your overall portfolio just to make sure you're cash flowing and you have a positive DSCR number as a person. And then they'll also, obviously, each property has its own formula. Most lenders want to see like a 1.2, which if you break it down, basically means that you're 120% cash flow. So like if your mortgage is $1,000, you need to be bringing in $1,200. That would be a 1.2 DSCR number. They also factor in for vacancy and stuff like that. So it's not just your PITI. They also factor in for vacancy and a couple other things. So again, that's a DSCR. I'll probably make a video with that because I could talk in lengths about that. But just when you hear DSCR, it's debt service coverage ratio, and it's lending off of the property because it has to be an income bringing property. You can't live there, obviously, because it's supposed to be a rental property. That's how it's qualifying you is off of the income. So it can't be a primary residence loan. You have to have the rental property. USDA loan, I'm not going to really get into this. This is a government-backed loan. It's basically like rural areas. They have some really cool products, though. If you do live in a rural area, they have like 0% down and all that stuff, but not going to get deep into that one. A VA loan, it's crazy to think some people in the military don't know what a VA loan is. Like, guys, this loan it's only for you. It's only for veterans, and it is an awesome loan product. You get the best rates, 0% down on a lot of times. Like if you're a veteran and not utilizing your VA loan, you can buy up to 4 units with this. That's another misconception. People think it's only primary residence. No, you can go buy a fourplex with the VA loan if you wanted to. Subject to. So in here, subject to, it's basically you're taking the rights to the property, but you're servicing the mortgage that still is on there, and you're keeping that mortgage on the property. It's staying in that person's name, staying in the seller's name. Again, this gets into the whole creative finance world. We could spend hours talking about it, but if you hear subject to, basically you're taking over their mortgage. The mortgage is staying in their name, and the title, the property is getting deeded to you. So you hold the title, but that old person's name is on the mortgage that has that to the property. So again, it can get real deep into the weeds here. It's getting really popular right now because people are basically selling off those 2 or 3% interest rates because it's just hard to come by. It's a great cash flow. I have a couple of subject twos, but I'm not huge on them just because I'm a value add person. You can't really do value add with subject two because the whole point of the subject two is keep the interest rate while I'm trying to refinance to get my cash back out. So it doesn't really make much sense for me to do. Mortgage broker. So this is a good one because a mortgage broker is essentially shopping your loan around. You're going to tell them what you want or what you have. Say, hey, I have this property. I need to buy it. I can't qualify because I have too high of a DTI, whatever it is. And then they're going to go shop around and say, hey, the lender will do this. I have a private investor will do this, yada, yada, yada. They're basically a middleman taking your situation and finding you what lender is best for you. So mortgage brokers could be great if you don't know anybody or you not sure what loan product to use, these guys a lot of times shop around DSCR loans. That's pretty much what a mortgage broker is for. They're going to go, they all pretty much can shop the same lenders. Everybody says, oh, I get the best rates, I get this. They're all really going to shop the same lenders unless they have a good private money investor where it's a fund or something like that not everybody has access to. But a lot of these people are just shopping the same mortgages. So, but be very cautious of their fees and stuff like that because they do get out of hand. I've seen people charge 3-4 points just for being a loan originator, which is wild. But hey, if that's what you need to get the thing done and it makes money, you got to do it sometimes. But pay attention to that. Owner finance or seller finance. This is a great strategy. I love it. Basically, I own a property outright. I want to be the bank. I can sell my property to you, and we can have a promissory note saying, hey, I'm going to pay you X amount of dollars and X amount of interest over X amount of terms. The best thing about this, it's literally however you negotiate. I have one of my seller finance houses right now, 0% interest. We convinced them to do a 15-year note at 0% interest. So how we did that is they told us, hey, this is the money we want per month. And I said, okay, I'm okay with that number. Are you okay with all principal payments? And they said yes. So if you factored it out, I think I'm paying like $200,000 less for that house that I'm not going to have to pay because there's no interest. And the whole monthly payment I send to them every month is all principal. And I think I only put like 5 or 10% down. And that was including the wholesale fee. So seller finance can be really good, especially if I have a bunch of seller finance deals I've done, even my multifamily. It's more common in multifamily because they usually have to be an investor. They have to understand the benefits of seller finance. If you're ever trying to pitch somebody seller finance, great thing to mention is, hey, do you know about the tax benefits of seller finance? Obviously, I'm not a CPA, but from what I've learned, a lot of dealing with that is to offset like a big tax bill. Because technically, when you sell real estate, you only get taxed on the income you actually took in. So say they have a $200,000 house and you only put 10% down, and for that year you only paid them $2,000 in interest for the whole year, they're only getting taxed on $12,000, the $10,000 down payment and the $2,000 in interest they took in. So if you're somebody who's on the fringe of a bracket and like, oh, well, I can't take this huge tax bill of $200,000 this year, I'll have to pay $40,000 in taxes or whatever. Well, okay, that's fine. Well, how about we do this? And then you structure where it gets paid out over time, their tax bill is significantly less and everybody wins. So, or if there's a property that maybe it's not selling or something like that, or they have a number in their head, like I bought one of my multifamilies, they were like, we got to get 400,000 out of it. I'm like, okay, well, what if I pay you 350, which is what I wanted to pay for it, but I'll give you, I'll pay you interest every month to get you that other 50 that you need. And they held the note at like a super low interest rate. It only cost me like, I think 10% down is all I put on that. And then I refinanced it 3 years later and paid them off. And I ended up making $150,000 after all that was said and done. And that was because the number they were trying to get at the time, it just was never going to sell for that. But I was able to get them the money that they wanted by paying the interest over the time. And because it cash flowed super well because I'm only paying them $1,500 a month in interest, which at the time was like 4% or something like that. And I just upped it every year. And then in the end, they ended up getting their $400,000 they wanted. And I got a cash flowing asset that I was able to refinance and make 150 grand on tax free. Everybody wins. So seller finance is awesome because it's literally however you negotiate it. That's I love seller finance. That's really real estate in general. However you can negotiate it. There's no set thing you can, like I said, I already have one. I'm paying 0 interest. It's the best thing. So, well, that wraps up today's episode about lending. If there's a certain loan product you guys want me to break down more, shoot me a DM or comment like, hey, I want to, this is the loan product I'm thinking about getting. What do you think? I'm open to talk about it. If you guys like the comment, please like, subscribe. I'll see you around for another episode. Thanks, guys. Have a good one.